Have you ever noticed something that just doesn't add up? Asset prices, housing, stocks keep hitting new records, and yet somehow you feel poorer, more stretched, like the ladder is moving up faster than you can climb. Today we're going to give you the map that explains exactly why that happens.
And this isn't just a feeling. There's a real mechanism behind it, one that's been documented across every major monetary expansion in modern history. If you don't understand it, you're flying blind. If you do understand it, you can start positioning on the right side of it.
So here's the central question. Why does new money, when it's created, benefit some people first and others last? And what does that mean for where your money sits right now? We'll break it down with a model you'll actually remember.
3 concepts, in order: the reservoir model, the Cantillon effect, and global liquidity as the macro layer underneath it all. By the end, you'll have a framework, not a prediction, but a genuine map of how money flows through the world. Let's get into it.
Imagine you're running a race, and every single year, you push yourself to run just a little bit faster.
Right, you're putting in the work.
Exactly. You put in more effort, you get a promotion, you earn a raise, you do absolutely everything society tells you is correct. But somehow, the finish line just keeps moving further and further away from you.
Yeah, it's a very specific, deeply frustrating contradiction.
It really is, and it's one that so many of you experience. You watch asset prices and housing keep climbing. The headline numbers on the financial news just keep going up, signaling this booming, prosperous system.
But you feel poorer.
Yes. You look at your own life, your own bank account, and your salary buys less every single year. How can both of these realities be true at once? How can the economy produce massive wealth on paper while your actual lived experience is that you are steadily falling behind the curve?
It feels like a paradox, but I promise you, it is not a paradox at all. There is a coherent map that explains this exact feeling.
And that's what we're doing here.
Exactly. In our deep dive, we are going to build that map together. We will construct it in 3 distinct layers to show you exactly how the financial system creates this precise dynamic. By the end, you will have a crystal clear picture of the mechanics driving that moving finish line.
Okay, let's unpack this because I think the confusion often starts with one single word, and that is inflation.
Oh, absolutely.
People tend to misunderstand the word inflation as like one big blob. We treat it like it is a single weather system raining down on the entire economy equally.
Like it hits everyone and everything at the exact same time.
Right, and at the exact same rate.
Yeah, and to understand the map, we must define our terms first, because that single weather system idea is a complete myth.
Yeah.
There are actually 2 distinct circuits of inflation operating in the background.
2 circuits.
Yes. The first is asset price inflation. This measures the rise in the price of things you own. So we're talking equities, real estate, housing, bonds, maybe fine art.
Got it. And the second?
The second circuit is cost of living inflation, which is often measured by the Consumer Price Index, or CPI. This measures the rise in the price of things you consume: your groceries, your monthly rent, your home energy bills, and your daily transport.
So we have things you own versus things you consume. 2 entirely separate tracks.
Yes. And here's the mechanism that separates them. When new money is created in the financial system, it does not enter both of these circuits equally.
And I'm guessing not at the same time either.
Definitely not at the same time. New money enters the asset circuit first. The reason for this is entirely structural. The financial system simply sits closest to the creation point of that money.
Meaning the central bank.
Right. Central banks inject liquidity by dealing directly with major financial institutions, not by, handing cash directly to local grocery stores or gas stations.
And that brings us to the payoff for you, the listener. That specific timing gap. The fact that the things you own go up in price long before the money ever reaches the things you consume is the actual engine of the feeling that you are falling behind.
Exactly.
Your wages stay perfectly static in that consumer circuit, while the houses you want to buy are soaring out of reach in the asset circuit.
To really visualize this timing gap, we need a mechanical model. Imagine 2 stacked water reservoirs.
Right, I have the picture in my head. We have a massive upper tank and a separate lower tank. Where does the water actually go?
Let's define the components first. The upper reservoir represents the asset markets. There is a spigot at the very top of this entire system, and it pours new liquidity directly into this upper reservoir first.
Yeah.
The lower reservoir, sitting directly beneath it, represents the real economy. This lower tank is where your wages, consumer prices, and household credit live.
And is there a connection between them?
Yes, between these two stacked reservoirs is a downward channel. That channel represents the translation mechanisms between high finance and the real economy, things like bank lending conditions and corporate wage bargaining.
Right.
And that channel is exceptionally narrow.
But hold on, let me push back on this.
Yeah.
If we are using gravity in this metaphor, shouldn't gravity eventually pull the water down?
You would think so.
I mean, if a massive corporation gets a flood of cheap credit in that upper reservoir, don't they eventually have to hire people or build physical factories? Shouldn't the upper reservoir eventually overflow, push through that narrow channel, and fill the lower reservoir where the real economy is?
It seems logical that it should work that way, but the mechanism functions entirely differently. The upper reservoir actually drains back into financial assets.
Wait, really? It drains back up?
Yes. Consider a major corporation that just secured a massive amount of cheap debt. Instead of taking that capital and building a new manufacturing plant, which would push water down into the real economy by creating permanent jobs and raising worker wages, they use that cheap debt to buy back their own stock.
Oh, wow.
Or they reinvest it in other financial instruments.
Yeah.
The water circulates right back into the top layer. It gets trapped in an endless loop up there before it ever has a chance to fully overflow downward.
Which means the lower reservoir only ever gets the leftovers. And those leftovers arrive very late. If that water is getting trapped in the top tank, that explains the illusion perfectly. This is why a citizen feels poorer even when headline wealth numbers look incredibly strong on paper.
Exactly.
The wealth is pooling in the top reservoir and constantly recycling itself there, while the person standing at the bottom gets essentially nothing but drops.
What's fascinating here is that this is not a new discovery. There is an 18th century economist named Richard Cantillon who documented this exact dynamic centuries ago.
The Cantillon effect.
Exactly. Let's define the Cantillon effect clearly. It is the economic principle stating that new money is not neutral. Money isn't a blanket that falls on the economy all at once.
It's a liquid, like a reservoir.
Right, it is a liquid. Whoever is closest to the source of new money benefits before prices adjust. Whoever is farthest from the source receives that money only after prices have already risen.
So proximity is everything.
Exactly. Whoever gets to drink from the fountain first gets the purest water. By the time it trickles down to everyone else, the water is muddy and prices have already gone up.
Let's walk through the modern money chain to make that incredibly real for the listener. It starts at the central bank. That is the ultimate spigot.
Yeah.
The money moves first to primary dealers and massive commercial banks. From there, it flows to large investment funds and major corporations.
And it stays there for a while.
Right. Then eventually, it makes its way to small businesses. After that, it trickles down to wages. Finally, at the very end of the line, it reaches consumer goods and rents.
Every single step in that chain adds a significant time lag.
And that lag is where the damage is done. The banks and funds get to buy assets before the prices move. By the time the money hits a worker's paycheck, the cost of living is already adjusted upward.
And here's a crucial nuance we must define first. The Cantillon effect does not require consumer price inflation or CPI to rise at all.
Wait, really?
It doesn't.
No, it can operate entirely in the asset domain, trapping the effects strictly in that upper reservoir we just mapped out. Here's where it gets really interesting. If you look at the documented historical period of the 2008 to 2021 quantitative easing era, you see exactly this phenomenon.
You absolutely do.
That massive monetary expansion produced very little CPI inflation for a long time, but it produced enormous asset inflation.
Huge amounts of it.
That historical era is the purest expression of the Cantillon effect. Asset holders gained massively, while deposit and salary holders did not, because they were simply too far away from the spigot.
Because the deposit and salary holders were too far down the chain. And to understand the sheer scale of what is flowing through that chain, we need to define the macro scaffolding underneath this entire model. We call this global liquidity.
Right, so this is the actual water in the reservoir.
Yes. Global liquidity is defined as the aggregate pool of credit and capital flowing through the world's banking systems and wholesale money markets. It is the lifeblood of the entire global financial system.
How big is this pool?
The size of this pool is approximately $150 to $170 trillion.
That is a number I cannot even wrap my head around. Where is that massive pool actually coming from? Central banks are obviously a major part of it, but they cannot be the whole story.
They aren't.
I know there are three main drivers of this pool. The first is central bank balance sheet operations. What are the other two engines pumping that water?
The second driver is private credit creation and shadow banking. To define that quickly, shadow banking refers to non-bank financial intermediaries that provide credit across the system outside of traditional banking regulations.
Okay, so a lot of unseen leverage.
Yes, they create immense amounts of credit. The third driver consists of cross-border capital flows as capital moves internationally seeking the best returns.
So central banks, private credit and shadow banking, and cross-border flows.
Correct. The key relationship you need to understand is that this aggregate pool is the single most important variable driving broad asset class prices.
How does that sequence work?
The mechanics work like this. Changes in this pool lead asset prices by weeks. Asset prices, in turn, lead the real economy by months. That sequencing is exactly the reservoir model we discussed, but quantified on a massive global scale.
So if I'm mapping this out in my head, let's look at how these three concepts combine into one cohesive chain. First, new liquidity is created by those three drivers.
Yeah.
Because of Cantillon proximity, it enters the financial system first. It fills the upper reservoir, meaning asset prices rise. Much later, a tiny trickle of that liquidity finally reaches wages and consumer goods down below.
Exactly.
But, as we established with the corporate buybacks, the upper reservoir drains back into financial instruments before it ever fully overflows downward.
The inescapable conclusion of this mechanism is that asset owners win systematically, while non-owners face higher costs without the benefit of the asset gains.
It feels rigged.
This asymmetry is not an accident. It is architectural. It is permanently built into how modern money creation works. The rules of the system dictate this precise outcome.
Wait, if that water is getting trapped in the top tank, that means anyone standing at the bottom isn't just missing out. They're actively being penalized because their living costs are going up while their assets aren't.
Yes, they bear the cost.
Let's map out exactly who is standing where. Near the spigot, getting first access, you have banks, large funds, massive corporations, and existing asset owners.
They get the purest water.
Exactly. They buy before prices rise. But far from the spigot, at the very bottom, you have wage earners, renters, and fixed income retirees. For them, costs rise first, and any asset gains arrive either indirectly or not at all.
If we connect this to the bigger picture, we can see an illustrative historical pattern very clearly. Look at sustained monetary expansions in the past.
Like the quantitative easing periods we mentioned.
Right. In those documented periods, the top wealth percentiles compound their wealth at a rate well above broad money growth. Meanwhile, the lower half of the distribution falls completely behind in real terms. The wealth gap comes down to proximity, not merit.
It essentially comes down to where you are standing when the water gets turned on.
Exactly. And the turning on and off of that water follows a structural rhythm. We call it the liquidity cycle.
Okay, cycle.
This cycle has a rhythm historically averaging 5 years. It is driven entirely by the maturity structure of world debt, as major corporate and sovereign debt obligations come due and require refinancing on a massive scale.
Let's spend a minute walking through the 4 phases of that cycle so the listener can truly spot the rhythm. It is not just random noise.
Far from it.
Phase 1 is expansion. This is when credit loosens, borrowing is easy, the upper reservoir fills rapidly, and risk assets rise. Then we hit phase 2, the peak. Growth decelerates, and we see late cycle rotation. Let's define that.
Late cycle rotation happens when the smartest capital realizes economic growth is slowing. Investors start rotating their money out of highly speculative, risky assets and into safer, more defensive positions.
Makes perfect sense. Then we drop into phase 3, contraction. Credit gets tighter. Banks become incredibly strict with their lending standards.
The water dries up.
Yeah, the upper reservoir actively drains, and risk assets fall across the board. Finally, phase 4 is the trough. This is maximum stress, forced deleveraging, where the system clears out the excess debt. After the trough, the cycle turns to begin anew.
The rhythm is relentless. It repeats historically over and over.
So what does this all mean? The takeaway for you is that knowing where you are in this cycle is far more useful than trying to pick individual winning stocks. Liquidity is the map. The individual assets are just the territory.
Which brings us directly to the listener's choices. If you hold no assets, the Cantillon mechanism works systematically against you.
Because you're at the very bottom of the chain.
Yes, you receive the new money last, long after the prices have already adjusted. You end up paying higher consumer prices, but you do it without the benefit of any asset price gains to offset those costs.
The educational implication here is deeply understanding which reservoir you are standing in. Being entirely in cash means you are sitting solely in the lower reservoir. You are waiting for the trickle.
Which may never arrive.
Right. Conversely, having diversified low-cost exposure to broad asset classes is how you gain partial participation in the upper reservoir, if it's a cup under the spigot.
And we must frame this explicitly. This framework is a map of how money flows so you can orient yourself. It is not a recommendation to buy or sell anything. It is purely an educational lens to understand the mechanics of capital.
Of course. And this raises an important question. What are the limits of this framework? We have to share the honest caveats.
Yes, this raises an important question indeed. The reservoir model is a simplification. Real capital flows are significantly more complex, and reverse flow absolutely exists in the system.
So it's not a perfect gravity model.
Right. Money can and does move upward from the real economy into assets as well.
Plus, global liquidity does not just override everything else. A company's actual fundamentals, valuations, macro geopolitics, and individual corporate credit cycles all interact constantly with the water in the reservoir. I mean, a bad business will still fail, even in a flooded reservoir.
Absolutely.
Okay.
And crucially, the cycle is probabilistic, not deterministic. It acts as a compass, not a clock.
I love that phrase.
Past correlations between liquidity and asset prices are simply documented historical relationships. They are absolutely not guarantees of future performance.
But even with those limits, the map reveals something vital. Your biggest risk may not actually be market volatility. It may simply be sitting entirely outside the upper reservoir.
This is educational content, not a buy or sell recommendation. Understanding how money flows is a map, not a prediction. Your numbers, your horizon, your risk.
So there it is, the full map. 2 inflations, 2 circuits. The upper reservoir fills first. Asset markets get new money before the real economy does. The Cantillon effect tells us proximity to the source is systematic advantage, and global liquidity, that $150 to $170 trillion pool, is the engine driving the whole cycle. Understanding which reservoir you're in is the beginning of financial literacy.
This is educational content, not a buy or sell recommendation. We're not telling you what to do with your money. We're giving you the map so you can make your own decisions. Understanding how money flows is a map, not a prediction. Your numbers, your horizon, your risk. Thanks for watching, and we'll see you in the next one.